Mr. Burr, what's up, my friend? We're running it back. We're going to react to some good old content.
Yeah.
But we're here in Phoenix, and I'm so grateful that you would sit down with me.
For sure, man.
Before we start watching these random clips that the media team put in front of us, any predictions on what some of the talking points are going to be?
Guaranteed, infinite banking is a scam. Life insurance, the agent's the only one that wins.
Yeah.
That's what I'm thinking we're gonna hear.
Yeah, amazing. All right, well, let's jump in. The first one that our team put down is why IBC is a waste of your money.
I recently saw an interesting TikTok where an infinite banking guru claimed he can put $275K a year for 10 years into a policy and then have access to 3.1 million of that to
Is that your video, you think?
It might be.
They're calling you
It
out,
might
bro.
be.
borrow against and buy real estate. It seems cool in theory. Unfortunately, nobody I know has that kind of money. And if they did, this would still be a massive, massive investing mistake. Hey, let's try investing this money normally, not paying any guru or company commissions or fees. And we'll see how that looks. Investing $275K a year for 10
I've already got a
years
take
in a
on it.
brokerage account in the S&P 500 index, compounding at 8% on average, would yield about 4.1 million to his 3.1 million. Ooh. As time passes, this gap gets much larger, even if the money is taxed. This is your money that you control. I think I'd rather do that and let banks give me loans for real estate. That's what they're there for, right? I hear they love people with 4 million or so in the bank. Like and follow.
This guy's great. Ooh. I mean, first thing I would say is he's missing the boat. He
Yeah.
said 275 as an investment.
Yes,
Life insurance is not an investment.
yes.
It's the worst investment there is because it's not an
Yeah.
investment. You can lose money in an investment. You can
Yeah.
never lose money in a life insurance contract.
Yeah,
Guaranteed to grow.
Yeah.
So he's missing the boat on what it is.
yeah,
And then he's also assuming an 8% gain every
Yeah.
single year because he's using average.
right.
Average is different than actual.
Yeah,
So I don't know. That's kind of my take on it. He's
Yeah.
missing the boat, and then he's inflating something with an average
Yeah.
instead of using an actual return.
yeah. So straight up, if the net worth was the thing that we were gaining for and optimizing for, and you were saying I could only pick one product to do that, I think you and I both would not choose whole life insurance if the end goal was net worth. I think that would be
Right.
something that you're a pretty intelligent person. Like that's not something that we'd be like, oh yeah, we're going to bet on whole life insurance versus any other asset that we know. I don't have a problem with 8%. I get it, and I'm with you. Like the average versus actual. I do think over a long period of time, I think 8 is way more fair than 12. And I think I really appreciate people that maybe use 6 or 7 because it's just like then you just know like hey they've kind of been around the block a few times and like from like planners standpoint 6 or 7 I think is like a conservative realistic number long term. But yeah, you're spot on. The number one talking point here is, ooh, it's a bad investment. Ooh, like, and it's like, yeah, I agree. And that's where I do think there are some people that give infinite banking a bad rap because they make it sound like it's the end all be all. And if we just take a step back and be like, oh, we're talking about banks and all, like where are you going to store and use your money? The average person or the typical person is making money. They're putting it into a checking account and then they're putting it into the S&P. That's great. They're getting the upside of that S&P. What people that do infinite banking, and I'm not saying infinite banking is for everybody, but the people that are doing that, they're putting their money into a whole life insurance policy. Yeah, it does not earn anywhere close to 8% every year, though when you add the tax-free growth and all, like you could potentially compete with it a little bit more than you might think. But the whole concept is, then what are you going to do with that capital over that period of time? Are you just going to park it? Well, then that could be an equivalent to a bond.
Right.
He's not talking about, oh, I'm putting money in the S&P. I can now leverage against half of my portfolio because you can't use 100% of your capital in an investment. And I don't think any of the good people that are talking about infinite banking are like, this is the end all be all. This is just a better place to protect, grow, and use your money. And over a period of time, I'd rather have the life insurance policy and my activity versus just the activity.
He mentioned like 3.1 to 4.1. Ooh, right?
Yeah. Ooh. That's
So he mentioned that, but it's like he's missing the point that it's not one or the other.
Correct.
With life insurance, if it's structured the way we know how to structure it and what we do for our clients, it's this, and you can use it for that. So if he really wanted to, he could put the money into a policy and then use it and put it into the S&P 500.
Yeah.
So now he's making his 8% average plus the 5% or so tax-free once you include dividends.
Yeah. If he did that, just to get in front of the comments, if he did that on a net worth standpoint, he would be a little bit behind. So if he could earn 8%, he puts it into a policy, takes a loan, he will be a little bit behind because the loan cost would be more than the internal rate of return probably over that 10, 20, 30-year period. Just hear me out here.
Right.
So on paper, you could look at that and say you're still behind. What are you not factoring in if you just stop there?
Death benefit.
You're not factoring in all the other benefits
and the protection
of insurance.
and
the creditor protections, the guarantees. Are taxes going up, going down? I have no idea. There's these things called chronic illness riders, living benefits of life insurance. You're right, a tax-free income death benefit. Like, there's other benefits that if you don't factor, you're like, maybe the S&P, if all we cared about was net worth, is a little bit ahead. But then when you factor in, like, what is the purpose of even retirement? It's future cash flow.
Right.
Could you have more options to even have more future cash flow with life insurance? The answer could be yes. But even if we put that aside, there's other benefits to life insurance that don't go into the equation.
If you think about it, let's say this guy was to pass away with $4.1 million. His family's not getting that because it'll be taxed. So what are they left with?
Yeah.
Right? With the 3.1, that was the cash value.
Yeah.
Death benefit would have been much higher.
That's right.
Right? So let's say the death benefit's 7-8 million. His family's going to get 7-8 million tax free.
Yeah.
And what I stress this to clients a lot now, and this actually changed when you and I had our first podcast.
Yeah.
I think it was on my podcast.
Yeah.
Is we insure as humans, we insure everything. We insure our cars.
Yeah.
We insure our houses.
Yeah.
There's no guarantee we're going to wreck our car.
Yeah.
There's no guarantee our house is going to burn down.
Yeah.
We have insurance on our phones.
Yeah.
Like, there's no guarantee I'm going to drop this thing.
Yeah.
Actually, there kind of is because I drop it all the freaking time.
I was about to say, you speak for yourself. I don't have insurance on my phone.
I don't know how this thing is not broken. We insure all these things that aren't guaranteed we're not guaranteed to need them.
Yeah.
We are guaranteed to die.
Yeah.
It's going to happen to everybody.
Yeah.
So why would you not insure that and then be able to leverage that death benefit
that
while you're alive?
guaranteed event. A guarantee you're going to die. And when it comes to planning, like, if you have guaranteed events in your life, that's one of the best things to be. Like, you don't know if your house is going to burn down. We have insurance anyways.
I'm guaranteed to have to pay taxes.
Yeah.
So what I do is I put money aside every single month to do it. It baffles me how more people don't just get insurance, even if it's just term insurance.
Yeah.
Like, you're guaranteed to pass away.
Yeah.
Why would you not protect your family against that loss?
Yeah. Next video is why infinite banking is a scam. All right, here we go. Buckle up. Why is infinite banking a scam?
The number one reason you should avoid infinite banking and IULs altogether is because all of those policies will eventually lapse if you can't keep up with the cost of the insurance. When you get into these things when you're 20, 30, 40, the promise is you're going to be able to harness that cash value and it's going to be invested and you're going to be able to borrow against it forever. What they don't tell you is the price of the insurance in your 20s, 30s is a small portion of the cost. But as you
Sounds like he's talking about IULs here.
Yeah.
As you get into your 50s, 60s, 70s, 80s, when you need the insurance the most, the cost of the insurance has risen significant. So in order to keep the policy from lapsing so that you can infinitely bank, you need to dump more money into the monthly premium, or you got to access the cash that's in there. That's the number one reason infinite banking is a scam and you should avoid it.
So this is to my point before where people are thinking that the product is the concept.
Yeah.
He's saying infinite banking is a scam because of this, and he's linking it to an IUL.
Yeah.
In my honest opinion, an IUL should never be used for infinite banking because of exactly what he's saying.
Yeah.
So every year you get older, you're more likely to die. Your insurance cost is higher. He's accurate. That's why we use whole life, because it's 100% level.
Yeah.
The cost of insurance is the same from day one until you're 121 years old. He's kind of right in that aspect, but an IUL is not infinite banking. Infinite banking is not IUL. Whole life is not infinite banking.
It's almost it's a good talking point to why we use whole life insurance.
Right.
I think that's number one. I think number two is if structured properly, you don't have to worry about keep funding. Like there's policies that we can structure from almost day one. The plane could land itself without funding, and this is not insurance advice, tax advice, investment advice. It's just like the reality is there's structures that's not true.
Right.
Now I will say that I am not a big fan of people banking, no pun intended, but I'm not a big fan of people like essentially banking on the fact that their life insurance policy is going to be their sole retirement income stream. And I do think that there is a problem, especially in the IUL space, because their whole pitch of IUL is retirement income. That's like the whole thing. It's like, this is going to be amazing, and there's a lot of levers that they pull to make it amazing. I'm not a fan with whole life or IUL just looking at the tax-free, and if you're listening to this, I'm using my fingers as quotations, tax-free income in retirement. I would just caution that because I don't know if it would work the way that you might think it is, and I don't think life insurance is necessarily designed to be annuitized.
When he said policies lapse, if it's a whole life, like I said before, cost of insurance is level.
Yeah.
It never goes up.
Yeah.
If anything, your premiums actually go down when your paid up additions drop off.
Yeah.
If you use the concept correctly, it can pretty much never lapse, because if, let's say, you bought a car with a policy and you paid yourself back for that car, that money's going back into the cash value.
Yeah.
And if you don't have new capital to fund premiums
Yeah.
the next year, you've got a whole bunch of capital in your cash value.
That's
you
correct.
can use the cash value to pay the premiums,
Yeah.
or you could do reduced paid ups.
Yeah.
And that's the thing that most people need to understand is, like, you can't just borrow from a policy and go to Vegas and blow it.
Yeah.
It's going to be bad.
Yeah.
But if you borrow from a policy and you have a plan to pay it back,
Yeah.
like if you borrow from the bank, you'd have to pay them back.
Yeah. Yeah.
On time.
Yeah.
With interest.
Yeah.
Just do that same thing
Yeah.
with your policy. If you do that, it cannot
Yeah.
lapse.
I'll just go on record. If all you're selling is life insurance for retirement, and the whole goal is just have it be a tax-free, sexy income stream, and you're going to put all your eggs in that basket, whether it's whole life or IUL, I would caution that. Don't necessarily know if that's going to translate the way that everyone thinks it is.
Well, yeah, to your point, if you think about retirement, like, you don't want to have to work at that point, right?
Right.
What brings in passive income? Investments.
Yep.
That's what you invest your money for future income.
Yep.
But yeah, if you're just using that,
It's for sure an and asset in retirement. I just don't want it to be the solo asset in retirement. How's that? How's that? I like that. We might have to do something with that. All right. Our boy Edward Collins with Up Level, he talks about infinite banking. Let's see what he has to say.
This is probably the biggest area of contention that I have with so many of the online gurus that talk about the infinite banking and the be your own bank strategies, because they don't really explain what that cash value is the right way. Many of those gurus will get online talking about how that cash value is your money and that you can simply deposit money into it and take money out of it at any time. And when you take money out of it in the form of loans, you're essentially paying it back to yourself. That just simply is not true. That cash value that exists inside of a permanent life insurance contract, that is not your money. In fact, if you took that money out, your policy would go away, it would lapse. What you have to understand is that that cash value component is really designed to support the policy. Now, the one thing that is absolutely correct is that the life insurance companies themselves, they do add some different benefits and features on the permanent policy side that makes it seem as though that money is quasi yours. So let's dive into what that looks like.
he's correct that the cash value isn't your money.
Yeah.
The cash value is equity in the contract.
Yep.
So it's just like if you had an equity line of credit on your house, you're borrowing the bank's money.
Yeah.
It's not your money, it's
Yep.
the bank's. But so he's correct on that point. I've seen so many of his videos,
Yeah.
and it's like he gets a lot of stuff right. But yeah, the one thing he did say about how it's used and how
Yeah.
it's leveraged is if you take the money out,
Yeah.
policy will lapse. That's not accurate.
Yeah.
If you withdraw the money, you'd get taxed above your cost basis.
Yeah.
But it's not going to lapse.
But that's a common strategy in retirement is people will say withdraw your up to basis and then take loans. He's essentially saying if you took maybe all your cash value and you withdrew it out and you didn't fund the policy, yeah, then it would lapse.
if you didn't fund the policy,
Yeah.
yeah. If you
Yeah.
didn't keep funding it.
But yeah, it's interesting. I do agree that there is a difference between cash value and just straight up your dollar. That
Yeah.
could be something that we could unpack. Would you rather have $100,000 of cash value or $100,000 of cash in a bank?
Cash value all day.
Yeah. Why?
Because I could use it and the 100 grand still compounds.
Yeah. And there's just other benefits tied to that cash value.
Right.
Hence why it might take a few years to compete or be better than like a checking account or a savings account. Is there's other costs associated with that, but over time there's other benefits as well.
Yeah.
My checking account or savings account doesn't give me a tax-free death benefit or other benefits that we get with life insurance. And as a result, I have more options. I would love to actually have Edward on and we talk about this in more nuance in detail to like hear him out more. I would say that I do have a problem with people talking about like when they're saying depositing your money. Like, yeah, that's language that we've probably all used. It's not a bank. And I think sometimes in the infinite banking space, like people can almost sell it like you're setting up a bank account. And it's a concept that, is really powerful to have like from a mental standpoint, but it doesn't necessarily mean that you're setting up a bank account. And I would imagine, because I've seen other of his stuff, I would imagine that he would bring up benefits, but I know he's pro this strategy. I've heard him talk about this strategy and how it can work if it's done well.
One thing you said is about like actual cash. Your cash is better than cash value, or cash value is better than.
Yep.
He mentioned this too. It's not your money that you're putting in and using. I would argue that, like, do you have cash on you?
Yep.
I would argue that's not yours either. It's just in your temporary possession.
Interesting.
If you spend it and you give it to Starbucks, whose money is it now?
Yeah.
That's one thing I really love about life insurance is like if you flow the money through a policy, it's not yours really because it's with the insurance company.
Yeah.
But those dollars will always make you money. Opposed to if I have my cash and I spend it, it's never going to make me money.
We put money in all kinds of things. Let's say you have money in an investment. That's yours, but it's not like it's available for you to use immediately. And so it goes down to cash value. Is that high in the control bucket or low in the control bucket? And I think we would say it's high in the control bucket.
Yeah.
Yeah. It's good. Yeah, Edward, would love to have you on. Would love to have you on the show and talk about the Rockefeller, because I've seen him do a video on the Rockefellers. I think it's a phenomenal video, and more on infinite banking. So, all right, let's go to the next video. I think this is it's our good friend Dave Ramsey.
Uncle Dave.
Oh, I think this might be the first Dave Ramsey reaction we've done together. So buckle up, man.
Infinite banking is another word for whole life insurance. That's all it is.
It's whole.
And to be fair, he's not necessarily wrong, but Dave's smart, and he knows that people use that concept to sell life insurance, and he's not necessarily wrong with that.
It's whole life?
Yeah, that's all it is. It's just whole life.
Oh.
You put a bunch of money in it, and then you borrow your own money out infinitely.
Yeah.
Which you've always been able to borrow your own money. That's not new. It's your money. You don't have to borrow it.
But you're doing it through a life insurance policy.
You put a chunk of money, way too much, into you overfund the whole life policy.
So what? So you put.
I love how Dave Ramsey's so consistent. That's what I love.
So
about
you
it.
put $50,000 like
up front in a whole life policy. You prepay it.
Yeah.
And so it creates instantaneous cash value.
So it's in there. Yes.
Yeah. And so I got a cash value. Now I want my cash value out of my whole life. There's only two ways to get it. It's my money that's in there, right?
Right.
There's only two ways to get it. Cancel the policy, take my money back out.
Sure.
They're going to kill you with fees.
Yeah.
Or I can borrow my own money and pay them interest to borrow my own money.
Mm-hmm.
And you can do that infinitely.
Mm-hmm.
So it's called infinite banking. It's infinitely stupid.
Okay. Well, I'm glad I asked.
Oh, man, so good. I'm going to let you hit this reaction. What's your thoughts?
Uncle Dave.
Infinitely stupid.
We've already touched on this. It's not your money.
Yeah.
You're borrowing the insurance company's money. Your money's held as collateral to get a loan from the insurance company.
Yeah.
You're essentially getting an advance of your future death benefit.
Yeah.
It's essentially what's happening.
Yeah.
So he's wrong. You're not borrowing your money. And then he's also said that it's just whole life insurance, which isn't accurate.
Yeah.
Because regular whole life insurance, you put 50 grand in, you've got access to zero.
Yeah.
Right?
Yeah.
You have to put 50 grand in the next year, you'd still have access to zero.
Yeah.
So it's life insurance that's set up for the cash value.
Yep.
And you're not borrowing your money.
Yep.
You're using your money as collateral and borrowing the insurance company's money.
He must have been doing some research on this, because in the past he's like, life insurance gives you zero cash value in the first year, and he even said in this video, you put 50 grand in and you have most of it. Like he said that you have almost like it instantaneously, which in the past he wouldn't use that word instantaneously from a cash value to immediately use. So you're only able to immediately use your capital if you have that cash available. So that's one thing that Dave has come around to, which is cool. And his whole point is, how dumb, like, why would you put your money into a life insurance policy to then borrow your own money out versus you could do it yourself? Like, how dumb do you think we are? There's zero value in, like, okay, yes, that would be dumb if there was no value that life insurance gave you now and in the future.
Right.
And if you think it's a total scam, if you think it's a terrible place to put your money, I would agree, Dave.
Yeah.
But if there's value to life insurance, 10, 15, 20, 30, 40 years, now and you're in the future, and you're telling me I can use my capital to put in business, real estate, the market, your mutual funds, that's the pitch.
Yeah.
But if you don't value life insurance, you don't see the value of it, then yeah, agreed, that don't do it.
And then he mentioned that if you want to use the money, you can borrow it.
Yeah.
You can withdraw
Surrender it. That was the two things.
And
Yeah.
they'll hit you a ton of fees.
Yeah.
But there's also called a free look period where you can get a policy, and then within a certain amount of time, you could cancel the policy, get every dollar back.
But also, okay, I think he said you could borrow it or you could surrender your policy, but you can also withdraw your money.
Right.
Now, I don't think you and I would recommend people just withdrawing their money left and right, because you can't necessarily put that back, but you can withdraw your money, and that's a third way to do it. But no, just very interesting. And you know what's also interesting is they just started a new channel called Ramsey Talks Insurance.
Really?
And so I think we're going to start seeing more insurance conversations from them, buy term and invest the difference, maybe disability insurance. So I'm hoping that some of these conversations, nuanced conversations, can happen. And I've been wanting to sit down with Dave Ramsey and the team, and I think we could have an amazing conversation. I'm so confident in that I think we could sit down and have an amazing conversation, and I think we would both realize that we agree a lot more than we disagree.
I think you'd probably be the best person to have that conversation.
That's the goal. That's what I'm working on.
Because, like, you had a great conversation with Curtis Ray.
Yeah.
Great conversation.
Yeah.
And we have great conversations because, like, you're not just, like, agreeing with everything that I'm saying.
Yes.
You give some pushback sometimes. No, I don't agree with that. I think it should be done this way or whatever.
Yeah.
Right? So I think it'd be an amazing conversation with Dave.
Let's make it happen.
So
in the comments, guys, the only way that this can happen is if people watch, subscribe, and help us grow our channel, because right now we're peons compared to Dave. But if we can continue to grow our influence, I think it's only a matter of time. We're in the same town.
Really?
He's 20 minutes from my house. Last video. Here we go.
Any form of life insurance as an investment is a scam. Here's some proof. These scammers are all over TikTok. They call it infinite banking, IUL, or MPI. They claim this will
we're highly offended by you putting it all in one bucket, by the way.
outperform traditional retirement accounts and has better tax advantages. Well, a personal finance guru I know, Personal Finance Club, bought a policy, got a 90-page disclosure, and eventually found all the fees. He pays $200 a month for this policy, minus a $12 premium expense charge, $12 monthly policy fee, $12 life insurance fee, $59 per unit fee. Yes, $96 of a $200 premium is fees. So tell me, life insurance gurus, how again is that going to outperform the market?
Don't you just want to give this guy a hug?
He needs it.
Richard, you're welcome to come on the show. I would love to sit down and talk with you and see where we agree, where we disagree, and so we'll definitely make that happen. What's your thoughts on this video?
It just goes back to what we've been saying this whole time, is so many people say infinite banking is IUL, it's MPI, it's whole life. Yep. It's not. It is literally just a concept. It's a way to move money. That's it. It just so happens to be that a properly structured whole life is the best vehicle to do it with.
Yeah.
Not MPI, not IULs. And what he's talking about
is an investment.
Yeah. It's not an investment.
I wouldn't call it a scam, but I would not disagree with that statement. Any type of life insurance as an investment, I would probably agree more with that statement than people might. Like, I agree that I wouldn't call it a scam. I think we throw out words like a scammer, and then we use it so many times where then it's like it doesn't have numb. It comes numb.
Yeah.
So I wouldn't call it a scam. You could just call it like, I would not invest. I would not put money into a life insurance as an investment alternative.
Right.
It's not a scam. You could do it. There's pros and cons to it. I think it would underperform investments. I want a game. I think one of the reasons why I might be good to talk to some of these people is I have a ton of empathy and I see their side. What I feel is most people they don't have empathy or take the time to listen to why someone would put money into insurance. And I think I think if we could come to the table and say, okay, let's have empathy for both sides, you would find that I would say that probably 85% of the population, I've said even higher percentages, but I would probably say 85% of Americans should probably not do permanent life insurance.
Should not?
Yeah, should not. Maybe that's too high, maybe that's too low, I'm not sure. If they heard me say that, they'd be like, "Oh, really? Like, let's talk." And it's because even in this example, $200 for whole life, or we don't even know, like, what type of policy is this? I don't know what the company, I don't know what the structure. So you throw things out like he puts $200 a month into life insurance. Okay, what type of life insurance? Why? How is it structured? There's so many questions. I don't even know what to say because I don't even know what the goal was.
Right.
You know what I'm saying?
Right.
And I would say you and I probably don't have too many clients that are putting $200 a month into permanent life insurance. I know for us, if someone only has $200 a month, unless they're a child, like it's a child policy, it's like, let's just do term that's convertible and save up. And so this is not insurance advice. Everyone has different areas, but it's like, that's where I think we would agree a lot more than we would disagree.
It should have been putting money into a life insurance contract as an investment is not doing the right thing. If you're selling it like that, if you're selling it as this is an investment, you're not doing the right thing.
Yeah.
That's not a scam.
Yeah.
Like at the end of the day, if you put $200 a month into a life insurance contract, regardless of what kind of contract it is, it's not a scam because eventually you're going to pass away and your family's going to get a death benefit. It's not a scam.
Also, life insurance is one of the most regulated spaces out there.
Right.
It's not a scam.
Right.
You know, especially, and then that's the other thing is mutual insurance companies, which we work with, the profits go back to the policyholder.
Right.
So yeah, are the executives getting paid well? Yes. But this is not like some person that's setting up an insurance company and just raking in. Like, they're literally setting it up to be a mutual carrier where the benefits get passed on. It's not a scam. You could say that it might not be as efficient. And again, newsflash, we're not here trying to say insurance is the end-all be-all investment.
Well, you just mentioned efficiency. I know that's a big thing for you. And I would agree 100%. I've started to really look at this with clients and with my own policies. Where can it be most efficient?
Yeah.
Great example. I have an equity line in my house.
Yep.
The rate's like 9%.
Yep.
Right? I think I owe like $200,000.
Yep.
I owe that or more on policy loans.
Yep.
If I have extra money, should it pay down a policy loan at 5% or pay down an equity line at 9%?
Yeah.
What's the more efficient thing to do?
Yeah.
Because I practice infinite banking, which is paying myself back, paying down these loans. The most efficient thing to do is to pay down 9% opposed to pay down 5%.
Correct.
Right?
Yeah, 100%.
So big thing that I've really focused on, again, is just each dollar, where can it be most efficient?
Correct. Love it.
And if I had an equity line at 3%, I would not pay that down.
Yeah, thank you.
I would pay down the 5% policy loan.
Yeah.
Now what I do is I look through all of my policies, all 15, and I look, what are the rates on each of them? One of them just had an anniversary date of December 28th, and the rate is now 7%.
Wow.
So
the loan rate.
Yeah. With Lafayette Life.
Okay.
So they just had high loan rates in December.
Yeah.
So it'll be that for 1 year.
Wow.
And then on December 28th, it'll whatever it is at the time.
Yeah.
So now what am I doing? Makes sense after I pay down an equity line to start paying down that 7% opposed to this 5% or this 5.5%.
It's like the paying off is super. I think that's really simple, and you nailed it. It's like pay off 9% cost to control versus 5%. No brainer. The next question comes: if you had a home equity or your policy, what would you choose to use first? And you could hypothetically say that you could still use the home equity potentially first if you value more safety, because a home equity is not 100% guaranteed to stay around the rest of your life kind of deal. Right. Whereas life insurance, you have those baked in guarantees. And the other thing is, this is something I think Brent and I talked when we chatted, is you could, let's say you have $1 million of cash value, and let's say it cost me 6% to take a loan against, and I could earn 9%. Well, that doesn't mean I'm going to take all my money out and earn 9%, because there is a spread there and I'm making money. Like, that is a profitable gig for me. But now I'm locking up I'm unable to say yes to a 12% or a 15% or a 20% or a 50% or a 100% opportunity.
Right.
I think that's the thing that I'm hoping more people in our space talk about is not only is making like more percentage than like buying a liability a good idea. So like we're already ahead paying 9%. The question is, what is the opportunity cost of having access to capital? For some people, it's not that much. For some people, having access to capital means they're going to go blow it on maybe a car that they shouldn't buy. So putting their money in a 9% investment is like forcing them not to make that bad decision and creating cash flow, which is great. For me, I always think, how much money would I want to tie up at 9%? Because I'm looking for deals and businesses that are going to be far greater than that. So am I okay making less in this year or next year while I look on how to deploy capital? And so it's constantly figuring out the question of where's the best use of my money. And when we could talk all day long about that. And the beautiful thing is everyone's different. Though when you're paying money back, it's very black and white.
Yeah.
Pay off the higher interest rate.
Yeah.
That's like pretty black and white. It's like how to deploy your capital that we could talk about. We could talk for days, and your risk tolerance and philosophy might be different than mine. And so there's not a right or wrong. It just, we have to understand that just because 9 is greater than 6 doesn't mean all our money goes into 9.
Right.
Because 12 is better than 9, potentially.
Right. Opportunities follow capital.
Yep.
If you've got a bunch of capital, opportunities are going to find you.
That's right.
So that was one of the things when we talked in the Bahamas where I'm just like, I need to start accumulating more because I didn't have a ton liquid.
Yep.
And I've had some really big opportunities come up because of that.
Yep.
So I've been able to throw a little bit of money here and there at these different opportunities. So it's big, man. It's just,
I love it.
Knowing what to put the money in is huge.
Yeah.
Especially if you're making the spread.
Yep. I know. And it's not a bad thing. It's not a bad thing. And so it's time will tell. Time will tell. And Mr. Burr, thank you.
Thank you, man. Appreciate you having me on.
I only went for a day, and that was my biggest regret because it was a phenomenal day. People start to see something in themselves they haven't seen before.
We are so excited to meet you all. We know that we are going to have a phenomenal opportunity to share all of our secrets.
We're open books, and we can't wait to share that information with you.